Now, I want to start this substantive part of this lecture with talking about three fallacies about crypto economics and token economics. Number one fallacy is that people perceive crypto entities as traditional firms. They often are not. It's very difficult to describe sometimes what they are, but I'll go into some details about how we should think about them. In many cases, the firms that issue some form of tokens are to be understood like a firm, so they have a business purpose and they want to create a business. But oftentimes these entities that issue it could also be different. So sometimes people develop something like self-propelled networks, if you want. The next big fallacy is that crypto trading is the same as traditional trading. Now, this is a very important feature of it, and it has implications that we have seen in recent days when, for instance, SIBO described that they would not, or decided that they would not issue any further futures on Bitcoin. And if you follow the news, you may have also noticed that the SEC and also the Ontario Security Commission rejected applications to establish Bitcoin ETFs, so exchange-traded funds. And finally, crypto assets are not the same thing as traditional equities. That too is an important feature of markets, and this is something which we're going to spend most of our time on. Now, the first thing I want to talk about, though, is trading, and I'm going to try to be as brief as I can about this. Now, in a traditional market, the following process is like this. So there's the individual, could be a person, or could be an institutional investor like Vanguard, wants to make a trade. They therefore send an order. It means that an order, a request to their broker. Then the broker sends this to a trading venue. If you're in the US, the broker has many choices. You can go to an exchange, a wholesaler, dark pool, or you can also internalize it with its own order flow. Then, in the ideal world, the trade clears, so there's a counterparty for the trade, and once that happens, it's sent to a settlement agency. So that involves the DTCC. It may also involve in some form the Federal Reserve for money transfers, and it involves custodian banks, and oftentimes also a firm called Broadridge, which records beneficial ownership of assets. Now, crypto markets are different. Let's just say that. So again, we have an investor who wants to make a trade. Now, this investor has multiple different choices. The first one is they can directly go to a venue. Now, the venue could be something like Polyonics, for instance. Now, the process here is different from that with a broker. A broker doesn't really have your assets. It's actually a custodian bank who has it. And a trading venue also never has custody of your assets. They basically just process messages. However, if you want to make a trade here, I pick Polyonics, what you have to do is you have to transfer your holdings from the blockchain to the wallet of the exchange. Now then the trade happens on the exchange, and you then have the choice to put it back onto the blockchain for final settlement. So all of these are your decisions, and in the process, I'm going to talk about that for some time, you actually incur a fair bit of risk. Now the next thing, and this is also interesting, is that in blockchain technology also have the option to do a direct on-chain transaction. So your assets never leave, if you want, the custody of the chain, but they stay on the chain. And the way you do this is you create a smart contract, register it on the blockchain, and then other parties can directly send money to that smart contract, and then the trade settles directly on the blockchain without any involvement ever of any third party, any other exchange, and so on and so forth. Now, there's simple systems for that. I'm going to talk about one in a minute. It's called EtherDelta. There are also more complex systems like 0x that have developed a protocol which then involves some form of time priority on the like. But the bottom line is that you have very different options, and that settlement is much more of a choice, and the custody is really on the chain rather than on a custodian bank and the like. Another implication is that really the brokers or the trading venues that you have in a blockchain work are much closer to brokers. Actually, this is not even that is fair. It's because they also have custody of your assets at some point. So, they're mixed really what they are. They look like a bank. And that has very important implications for the regulation and also the way we think about these assets. Now, this raises immediate concerns, and I have some big ones about that. Number one, So if you want to, there's actually about 300 different trading venues. 12 or 15 of those account for most of the volume, but still that's a large number of venues. Number one. Number two, now that's not unlike what you have in equity markets, but importantly, you need a lot of money to make arbitrage trades. Why? Because, well, you have to have holdings at each of these venues in some form or another if you want to make a trade. Now, what that implies is that it's actually pretty difficult to align the prices on these different venues with one another. And, there is not necessarily a free flow of capital between venues. So that has implications of how we think about prices. The prices cannot generally be thought of as arbitrage free, even over longer horizons. Number two, the decentralized trading creates the possibility that you can trade totally anonymously with yourself, and then you can manipulate prices quite easily. So you can easily engage in wash trades. So those are trades where you trade with yourself. So for fun, for instance, one of the things that I did was, you can issue your own token, which is essentially just a smart contract, and you could trade it with yourself using EtherDelta, and basically give the impression of having a token which is extremely valuable. Now, this is very hard, especially in a decentralized world, to detect, and therefore, again, you have to be very cautious for how you interpret these prices. And many of the trading venues actually don't even enforce or police self-trades. And then finally, there is a question about the brokers. I talked about that already, right? So the brokers or the exchanges really are sort of like broker banks. They're a single point of failure, and this raises really gigantic concerns. Now, here's some of the things. So we heard already that the CBOE isn't listing any new Bitcoin futures contracts, citing basically there is no more appetite for investors for Bitcoin. Fair enough. You may have also heard that the security regulators in the US and Canada have rejected all applications so far for Bitcoin ETFs. The reason being that an ETF will basically put Bitcoin, so the equivalent of Bitcoin, in the hands of a retail investor, and the argument of the OSC and the SEC was, well, we don't really know what the price is. Well, how do you know what the price is? Because there's nothing really that is well established. Now, there's some firms in Canada, for instance, called Concilium. What they have is they have a mechanism by which they try to provide at least some form of reference prices for crypto markets. So there are mechanisms, and people are trying to work very seriously, also scientifically, trying to get this ecosystem to work. But for now, there's major concerns about prices in markets. Now, I wanted to briefly talk about EtherDelta. Now, EtherDelta is essentially like a key GG where they basically establish a smart contract for you. So this looks like a website, like a trading venue, but really what it is, it just derives and extracts information from the blockchain. And each order here is really just 300 lines of code. Now, the really cool thing is, in principle, this is the functionality, the basic functionality of buyers and sellers finding one another has been provided by this simple website here and by the smart contracts that exist on the blockchain. Or in other words, the trading function of an exchange in a rudimentary form have just been replaced by a few hundred lines of code. This is quite remarkable. The SEC did not quite agree on finding it quite so remarkable. Instead, they sued the developer of EtherDelta and described that he basically operates an illegal trading venue. This is one way how you can go after regulation in a decentralized world. You go after the people who usually have a home address. So here we have that. That's a little sad because ultimately this is it's a pretty neat idea to trade these these widgets with one another. Now, last thing I want to say, crypto exchanges are a security risk. It started in 2014 when a place Mt. Gox was hacked, and a very large number of Bitcoins got lost at the time. People were protesting. People lost, the equivalent of hundreds of thousands of dollars, including some of my students. Bitfinex got hacked in 2016. Another venue got hacked where 500 million of cryptocurrency were stolen, and it goes on and on and on. Bittrex was hacked. Many places were hacked. The biggest in Canada recently was, of course, the Quadriga X, where the owner of Quadriga X died, or allegedly died, and claimed that he only had the passwords that could unlock the millions of their customers. So people lost on the order of 200 million Canadian. It's not, by now I think we know that some of this money was actually never there, that it was actually most likely stolen by the owner or owners of Quadriga X. Now, this is not really quite clear, but at least this is how I read the news at this point. If you look at the quota spread, however, of trading on these markets, you see that Bitcoin in particular trades at very tight spreads of just a few basis points. If you look at the trading volume, though, and at the activity levels in and out of trading venues, whenever there was a hack, these are the spikes. It is quite visible that there is a huge amount of activity going on whenever there are hacks. And here we have it. Now, last thing, there's a question about the regulation. Quadriga X, people complain to the regulator about it, and the BC Commission, because Quadriga is located formerly in the province of British Columbia in Canada, ruled that it's not to the best of their knowledge. Quadriga X did not trade securities, so they treated whatever was traded on Quadriga. They thought it was not a security, and therefore they did not have jurisdiction over Quadriga X. So, in other words, people were out of luck. There you go. This is it. Now, just a few pieces of trading data. Most of the trading that occurs on venues is fiat to crypto, and for those that are crypto to crypto, most of it is Bitcoin to some other crypto. Ethereum makes up, probably another 10% of trading. Not an awful lot, but most of the trading really involves some form of crypto trading against Bitcoin. Where does the trading take place? Well, if you look at this map, you can see a large portion happens in the US, of course, very little in Canada. The UK has a very super proportional amount of trading happening, Switzerland too. But if you really are very serious, you see most of the trading happens in Japan. Hong Kong has about the same trading volume as the US as a whole. Singapore has an enormous amount of trading, New Zealand too. Singapore is just really this tiny speck on the map here. So you can see how trading is relatively unbalanced. Now, if you look at the distribution, the changes of beneficiary ownership over time, you see that, and those are basically the trades that go in and out from the exchange addresses. And for most of these, the changes are very, very small, meaning that the money actually stays in the exchanges, that people keep their money in the exchanges, which I say is a security concern. Yeah? So they never really get settled on the blockchain. Some tokens see a lot of their transactions happening on-chain, but that's most likely the case because these tokens are in use or in some form or another. Now, if you look at the market value, we talked about this earlier already. So, if you look at new issuances and trading volume, all crypto markets, are about 1. If you take all crypto trading worldwide, then that is more than what is traded on the Toronto Stock Exchange, which is one of the top 10 markets in the world, equity markets in the world. So that's quite remarkable. Right, just one thing about transactions costs. So if you want to sell 200 shares on Island ECN on Nasdaq, you have to pay a fee of $5 for that. And here's basically a description of the total cost that you have. Depending on how you trade, a 200,000 share order costs you about $1,300 to or $1,000, depending on how you trade. So that is a sizable amount of trading. But if you look at the same amount, if you look at the same for crypto, the amounts are dramatically higher, right? So now, so if you take the crypto exchange fees for a $1 million market order, well, so if you had 25 basis points is the standard trade size for that, you would have to pay $2,500 for that. And then you still have a in and out fee from these crypto exchanges of 0.1% to 3%. And you have to pay a small mining fee, which could be in the order of cents. So in other words, crypto trading is actually quite expensive. Likewise, if we look at quota bid-ask spreads, so here we have those for the TSX, some TSX data. TSX 60 is about 5 basis points. TSX completion, which is the TSX composite that is not TSX, is about 15 basis points. Small cap, 25 basis points. Now, Bitcoin is equally competitive as major equities, about 5 basis points. Bitcoin to Ether is even better. And Bitcoin to most of the other cryptocurrencies is still very good. However, now if we look at tokens, then things look very different. So as I said, TSX small cap is pretty large, it's 25 basis points. The best venue for token transactions that we could find for all token transactions was about 35 basis points. The best in the US was about 55 basis points. Now, if we go to the Canadian ones, the costs are quite horrendous, right? So it's almost 1,000 basis point or 10%, right, for transactions. And the average worldwide is on the order of 1,500 basis points for a transaction. So, the costs for trading of these tokens are humongous. So, summary here, it's a very active market. We don't know what the trading rules are, so it's hard to tell what the price is. Exchanges are like brokers/banks, and therefore they have security risk and they're very high fees. Exchange fees, they're very high, bid-ask spreads involved. Now, decentralization is happening and decentralized trading is actually possible. So, in that sense, the promise of a decentralized economy, at least when it comes to corporate trading, is there.